Over the next 30 minutes, we will, alongside our partners from Harvey, Spack, present a mix of data, insight, and opinion on why we see the potential for retail parks to be the dominant form of physical retail in the future for the majority of the UK. Our hypothesis is based on a consideration of the strengths of the retail park format from the perspective of the consumer, the occupier, and the investor. And whilst recognising that retail parks are a broad church with numerous differences, we feel there are underlying qualities that typically manifest themselves better in retail parks than in other formats of physical retail. These qualities are, number one, the delivery of convenience that is typically better provided through the retail park format than in other forms of physical retail. And number two, retail parks provide a form of physical retail that is the ideal complement to online. And number three, retail parks increasingly provide an experiential offer that is more relevant and often superior than that provided by their in-town competitors. So my name's Andrew McVicker. I'm the Director of Property at Pragma, and I'll be talking you through our consideration from the consumer perspective. Joining me today are Nalin and Ben from Harvey, Spack, and they'll present a view from the perspective of the occupier and the investor. And if time allows, we'll have a short Q&A at the end of the session. Just to give a very brief introduction as to who we are, Pragma are management consultants specialising in retail, travel and mixed-use commercial spaces. Our work is to create relevant and implementable strategies that deliver against key stakeholder objectives. We've been in operation for over 30 years. Our work is global and across multiple formats. And it's this experience that we have created and provide to our clients that we feel gives us the relevance to be able to offer a valid opinion on this format and sector. So to start our session off today, I'm going to hand over to Nalin, and he's going to talk through our view from the perspective of the occupier. Nalin, over to you.
Thank you, Andrew, and good morning, everyone. As Andrew said, my name is Nalin Nilaweera. I'm a partner at Harvey, Spack, and I lead the landlord, leasing and asset management team. In terms of a bit of background about Harvey, Spack, we've been going for over 40 years, and we are out-of-town retail park and leisure specialists advising investors, developers, landlords and occupiers across the disciplines of investment, agency and development and profession. So today I'll be talking about who the occupier is, how they've been performing over the last sort of 15 months, and will this performance continue into the future? In terms of defining the retail park occupier, starting with value non-food, this can be defined as occupiers including B&M, Home Bargains and The Range. Value food would be Aldi, Lidl, the Food Warehouse. Grocery would be the big four of Sainsbury's, Morrison's, Asda and Tesco, but also relevant is M&S Simply Food because they have significant out-of-town representation and they're looking to expand that quite significantly. Moving on to DIY and bulky, DIY would be Home-Based, B&Q and Wickes, and bulky tenants would include the likes of DFS, Pets at Home, Wren Kitchens, Halfords, Dreams, Currys, Carpet-Rite and Tappy. Open A1 fashion would be the likes of Hobbycraft, Smith's Toys, Sports Direct, JD Sports, Boots, Next, River Island, and leisure. It's most prevalent to talk about the gyms at the moment, given that they are expanding so rapidly on retail parks. And that's really led by The Gym, Pure Gym, and then following on from that, our family activity centres such as Ninja Warrior, Rock Up, Clip and Climb, to build on what is already build the base of cinemas and casual dining and drive-throughs. So how have they been doing? In terms of how where we start with this, I think it's important to look back to Q1 2020. So just before COVID kicked in, And at that point, confidence in the sector was a bit mixed. Of the subsectors listed, confidence was strong in value, non-food, food and grocery, and elements of DIY. However, uncertainty remained across much of the other subsectors, with a number of tenants in the midst of a restructure or rumoured to be looking to do so. Fast forward 15 months to now, and the majority, if not all, the restructures happened and are complete. And as a result, we now have a much more stable and certain supply dynamic within the sector. The tenant restructures, as well as bringing more certainty, has also brought more space to the market. And whilst this has served lower rents in the short term, has enabled or attracted established occupiers and new entrants into the market. So vacancy rates have not crept up too significantly. Now, I'd say that the uptake of space hasn't just been fueled by tenants looking to get a cheap deal. There's no question that out-of-town retailers have performed very well over the last 15 months, and certainly in between lockdowns when the shops were able to reopen. I think it's certainly fair to say that the parks have performed much better than their contemporaries of shopping centres and in-town locations. So I think that the reason why the occupiers have been expanding so much is not just sensing a quick deal or a cheaper deal, but it's also because the tills have been ringing and performance of their out-of-town parks have been very strong. If we revisit the subsector list, which I went through initially, value non-food was deemed an essential retailer, as was value food, and grocery also. Value non-food has performed very well during that period. I know we've seen, certainly talking to the likes of Poundland, I know their out-of-town portfolio performed stronger than their in-town portfolio in the majority of cases. And certainly in some of their shopping centres, in-town locations, they really struggled because they were opening with increased costs due to COVID, and but ultimately had no custom because they're in a shopping centre, one of 30 tenants, of which the majority are shut. There just wasn't the customer experience to attract tenants into their stores. So ultimately trading was very poor in those locations. As I mentioned, grocery has been strong. And certainly the big four did very well with their online presence. And I think they certainly did better than the Audis and the Lidls, although they are now looking to expand that sector of their business. M&S Simply Food are continuing to expand aggressively. So again, those sectors have been very robust. I think the most interesting sector which has recovered is DIY and bulky. And it's a very simplistic thing to say, but I do feel there's a level of accuracy to it, and that if people aren't spending money on their holidays, they are spending money on their homes. DIY was deemed an essential retailer, so they were able to win back a lot of customers that may have gone elsewhere during to competitors. And certainly bulky tenants have seen sales in furniture, carpets, electricals, pets really increase quite significantly. Open A1 fashion, it's still a subsector which there is concern over, but it was consistent across all of those occupiers that the out-of-town portfolios performed extremely strongly during that period. I think leisure is an interesting one because certainly within the gym market, we've seen a number of deals that got worse during COVID have been renegotiated by landlords post-COVID back to pre-COVID levels. You can understand it from the gym perspective. During COVID, they don't have an online presence, the membership base evaporated, but post-COVID, the base has really recovered very well. So landlords have been able to go back to the occupiers to say, we need the deals to go, or to improve to the previous levels when they started. In terms of will this trend continue? I mean, I know we're all crystal ball gazing a bit, but there are many investors who have come into the sector in quite a strong way in the last 12 to 15 months. So there is certainly a safety in numbers approach now thinking, which I think Ben will come on to talk about in a little bit. What I know is this: at Harvey Spack Field, we advise on over 15 million square feet of landlord space across 160 parks. We act on 5 million square feet of occupier estates. So overall, on a daily basis, we have visibility over 20 million square feet, and we have over 200 deals in negotiation at any one time. So I think that gives us incredible insight and visibility to up-to-date market activity. And what we're certainly seeing is that occupiers certainly have more confidence in this sector, and certainly in the short to medium term. And this is ultimately justified by the high levels of trade that they have been experiencing during and after COVID. I mean, if we look at some of the snippets that we've seen in the press over the last year, Homebase have exited their CVA early, which is almost unprecedented, and are now back acquiring space. DFS have said they have recovered all the sales that they lost, or they thought they lost during the lockdowns. Pets at Home have hit the 1 billion turnover mark. A number of occupiers have returned further. New store formats from the likes of B&Q, Poundland, and the value sector of non-food and food continues to power ahead. Fashion is an interesting one because whilst there is still risks around mid-market fashion, we've got up-to-the-minute examples where major names are closing their town or city centre representation because a large department store in the location is closed, and therefore the occupier is looking to consolidate their representation in the town on the retail park by re-gearing for a further 5 years and looking to refit their stores. So whilst there's certainly some risks attached within that sector, we're seeing on retail parks some very positive movement. Now, it's easy to get carried away, but an appropriate term I would use is cautious optimism. The presence of online is here, and there's no question that's here to stay. And Andrew will no doubt talk about that in his section after this. But in terms of the long-term outlook, it's really how retail parks can align itself alongside the spend within online. And for me, I think it has every chance of being the sector which is able to do that the best. And the reasons behind that, it really goes back to the first principles of resale warehousing, and what brought them forward by the likes of Harvey Spack and Russell Field, who were some of the pioneers of this market in the 1980s, whereby the retail parks were effectively based around a shopping destination that is easy to access, efficient, free parking, regular shaped units, lower service charges, and ultimately convenient. So when you put those factors together, you look about how click and collect and returns can align itself against online, it certainly puts itself in a good place. I'll now hand over to Andrew, who will hopefully provide some data to back up what I've been talking about, and apologies for the technical glitches. Thank you.
Thanks, Nalin. So I was just going to talk through a view from the consumer perspective. And I think any sort of discussion around format of physical retail needs to acknowledge the role of online, as Nalin has mentioned. Now, during the lockdowns that we've had across the UK over the last sort of 12 to 15 months, I think the proportion of sales that have gone online has averaged at around 31% and has gone as high as 36%. And there's multiple views as to where that might go in the future. I think one view says that we've seen significant acceleration of growth, almost 5 years worth of growth, maybe in the last 15 months. And so the expectation could be to see that drop away as physical stores reopen, and then grow and build back up over the next years to a point of taking around 34% market share by 2030. Alternatively, there's a view that says that during the last 15 months, a huge amount of consumers have been exposed and forced to engage with online, and that once that box is now open, it won't return, and we will see growth continue to extend over the following years. No matter your point of view and perspective as to how big a market share online will account for in the future, the fundamental point is that it's not going away, and it continues to provide and present a challenge to physical retail. Now, we're all shopping online more, and so we all know that it's a great tool for being able to browse, to research, and to transact as well. And the strength of those particular elements means that physical retailing is being polarized into two distinct areas, one being convenience and the other being experience. Now, convenience is clear to understand the relevance of it. People want to see, they want to touch, they want to feel, and they want to grab hold of a product and take it away with them as of now. And this is all stuff that online still cannot do. On the experience side, we're typically seeing retailers looking to use their physical format stores to build a brand and engage with a consumer, something that is increasingly difficult for brands to do online in what is an increasingly crowded marketplace. Now, when retailers are looking to build these experiences, they typically focus on the larger locations, which have wider catchments, more diverse catchments, and typically larger footfall. And therefore, that means that for a large proportion of the UK, the primary purpose of physical retail is going to be that convenience format. So in terms of convenience for the consumer, we see typically a significant advantage to retail parks as a format over its competitors of town centres or in-town shopping centres. Now, we recognise that all forms of physical retail are a broad church, and the scoring metrics that we're showing here may not apply to all individual centres. But when we look at key elements around accessibility, convenience, environment, and offer, I think we see some key strengths for retail parks as a format that we believe will stand them in good stead going forward. In particular, a number of these are the opening hours that you can achieve on a retail park, or that retail parks typically provide. And I think as people's work and home dynamic becomes more flexible, those extended opening hours will really benefit retail parks as a format. Parking is always a hot and sensitive topic, I know, amongst both landlords and amongst consumers, but 81% of the UK population have access to a car, and it's still the favoured format for consumers for accessing physical retail. So car parking is a key element, and two things that are of note. I think the availability of car parking is inherent in retail parks, and it's typically surface level, which is favoured by the consumer, and it also provides the ability to park literally outside the door of a store. Now, this isn't always a guarantee of success, and I think we've seen examples at Rushden Lakes or Banbury Gateway, recently developed retail parks that have almost been a victim of their own success, and parking is a key issue at both of these sites at weekends due to their popularity. But generally, the availability of parking stands retail parks in good stead. And then there's the thorny issue of payment, and although this takes into account parking charges and also takes into account how you are able to pay for parking, I think what needs to be grappled is the underlying principle that people just do not like paying for parking. And increasingly, the job of physical retail is to attract people to these sites. And in doing so, any sort of payment for parking puts up a barrier against use, which is increasingly frowned upon from consumers. I think click and collect is a key factor that will stand retail parks in good stead going forward, and the increased use of click and collects favours retail parks as a format due to those wider opening hours and the availability of parking. I think COVID is hopefully a short-term impact, but we've absolutely seen the favour that consumers have held the format in during COVID restrictions due to the open air environment, but also the ability to implement strategies that apply to all tenants rather than town centres that have struggled with diversified ownership. And that's been reflected in the return of footfall to pre-pandemic levels much quicker than in other forms of physical retail, and also a vacancy rate that is considerably lower on average than other formats of physical retail. And again, if we're going to get people away from their tablets, computers and mobiles and get them engaging in physical retail, then having vibrancy through footfall and having vibrancy through active shop fronts are something that are going to be key in attracting consumers. Finally, as well, in terms of dealing with a world where online has an increased market share, it's vital that when people do engage with a physical retail offer, the physical offer provides both the size of store and the ability to hold a full range that is at least a credit to the occupier, the brand, and what the consumer can see online. No one wants to view a huge portfolio of products and offers online, go to their local store and find only a fraction of them available and in a size or a category that doesn't suit them. So retail parks, again, generally have that larger floor plate that allows for a broader range, and increasingly due to their performance are seeing reinvestment in fit outs that is superior to their in-town competitors. I've talked about how online is creating a divergence between either convenience or experience in physical retail. But what is important to say is that ultimately it's relevance that will drive performance by attracting the consumer. And what we see with the projected shares for online by merchandise category is that a number of the merchandise categories that will be least impacted by online have historically favoured retail parks as a format. So the likes of grocery, with the growth of Aldi, Lidl, and the food warehouse, stands retail parks in good stead. In F&B, we've seen numerous examples of fast food operators closing in-town stores and favouring out-of-town locations because of their drive-through capability. For leisure goods, we've seen a historic prevalence for retail parks as a format. So the likes of Sports Direct, Decathlon, Hobbycraft, Smith's Toys, all favouring that out-of-town format. And increasingly with the demise of Debenhams and the closure of House of Fraser stores, the household goods markets is becoming essentially an out-of-town format. You know, there's very few locations in town that you can now buy homeware goods versus the likes of Dunelm, Oak Furniture and Homebase, providing a real strength of offer at a local level from an out-of-town format. So all of these merchandise categories that have historically stood the retail park in good stead, we think will continue to do so going forward and retain that relevance for consumers. I think finally, the last point to say is on an experience basis. And historically, retail parks have actually been a strong provider of experience for smaller locations across the UK, often housing a town's cinema offer, which was then complemented by F&B. And increasingly, we're seeing gyms favouring it as a format and taking locations on an out-of-town basis. We see a huge opportunity going forward for the provision of leisure and leisure facilities. And we're seeing that at the moment in the expansion of the likes of Clip and Climb, trampoline operators, Ninja Warrior, etc. And typically, again, these guys are favouring the retail park format. And typically where we see outside the big cities across the UK, retail parks have often grasped what the consumer is looking for and been able to provide a home for these types of experiences much more quickly than either in-town shopping centres or high streets have been able to do. And it's for those reasons across convenience, the complement that retail parks as a format offer to online, and for the increasingly relevant experiential offer. These are the reasons that we see retail parks as a format potentially dominating the UK scene going forward. So I'm just going to hand over now to Ben, who's going to talk this through from an investor point of view.
Good morning. Hello, my name is Ben Turquet, and I'm a partner in the investment team at Harvey, Spack with almost 20 years of retail warehouse investment experience. I'm going to talk about the current trends within the investment market and how retail warehousing as an investment asset class is making a bit of renaissance. This is mainly driven by the general belief and understanding that certain aspects of the retail warehouse market are robust and solid, driven predominantly by the concept of convenience. So, increased investor confidence in both multi-let and single-let retail warehouse assets has been demonstrated by a bumper year thus far in the retail warehouse sector, and we're only in June. We estimate circa £1.5 billion worth of non-food retail warehouse assets have been traded thus far in 2021. Notably, the first 4 months of 2021 were in national lockdown. Potential investors have spent a large part of the last 2 years considering what represents good and bad retail. Temptation is to consider all retail bad for a while, particularly if you're a valuer. Investors have seen the resilience of convenience as a requirement and retail parks as a format of choice for consumers seeking it and occupiers providing it. With less exposure to mid-market fashion, the sector has also seen less insolvency activity than the rest of retail, whilst its large units and ample car parking provision have also meant it's proven to be more socially distancing friendly. A higher proportion of retailers remained open during the initial crisis than in shopping centres or on high streets, and as a direct result, rent and service charge payments have been higher. This has culminated in a stronger footfall recovery and more robust trading performance across a number of retail warehouse-focused subsectors. Schemes that are dominant or convenient will continue to be top of investors' wish lists, particularly those with a food store anchor. Where investors see demand for space, they also see opportunities for potential growth. The knock-on effect of institutions returning to the market is leading to a wider audience of investors, i.e. private equity-backed vehicles and newer entrants, including overseas investors. You may have seen the Omaha portfolio was acquired by a Hong Kong-based private investor. And also traditional propcos such as BL are making a foray back into the market. Brookhouse has invested almost £500 million in the sector, buying the Hamilton portfolio and 2 assets from the Nuveen's Retail Warehouse Fund. And coming back to BL, so last year they sold almost £500 million of retail, but this year they've come back to the sector as an investor. They bought the A1 shopping park in Biggleswade, and they've now also taken control of the Hercules Unit Trust, which is their main vehicle for retail warehouse assets. Columbia Threadneedle is another important investor. They first started buying retail warehousing again back in December, and that has definitely led other institutions to come back to the market. The synergy of investor and occupier at retail parks is far greater than versus high street and shopping centres, which leads to far better inward investment. Before we all get carried away, retail parks do vary from region to region in terms of location, size, format, mix and competition. It is this variation that provides the winners and losers, and investors see an opportunity to outperform the market via their assessment of those opportunities. It's also worth stressing that the best prices achieved this year have been on those assets that could provide an alternative end use, should it no longer be in retail use, particularly in the southeast, where there could be a change in use to either residential or logistics. I will now hand over back to Andrew to sum up our collective thoughts. Andrew?
Thanks, Ben. Much appreciated. And so appreciate on time, we're coming close to the end of what we wanted to present today. But I think in summary, we hope that through the opinions and evidence provided today from both ourselves and Harvey Spack Field, we're providing a rounded view of why we see from the consumer, occupier and investor perspective, real potential in retail parks. And I think in summary, that is whether it be the short-term or hopefully short-term impact of COVID, or whether it's the longer-term impact of online and how that is changing consumer and occupier behaviours. We see retail parks as being a format that has real strength and longevity, particularly versus some of the alternative physical formats available. I think the relevance to the consumer and the occupier is key in attracting investors. And clearly the attraction of investors provides the financial stimulus that creates and maintains relevant destinations, which completes the cycle back through to consumers and occupiers. Now, as we've continually highlighted, not all retail parks are equal. There are a hugely diverse set of assets, and many of them will be challenged by micro factors, cases of oversupply in local areas, and also challenged by the competitiveness of rents. And we're seeing increasingly in-town rents falling to levels that make them hugely competitive in terms of trying to attract occupiers back to town centre and shopping centre formats. But I think that divergence of different dynamics is ultimately what creates the winners and losers and attracts investors and asset managers with the potential to outperform both the market and other assets within their portfolio. And therefore, those underlying opportunities we see as being absolutely key. And those landlords and occupiers that can get it right will be absolutely well placed going forward to provide a relevant physical offer that really complements online well and attracts and continues to attract consumers and occupiers to their schemes. So in terms of today, we will be providing everyone who has registered a link to a recording of today's session. We'll also provide a link to the white paper that Pragma published around retail parks and how we see this view around their viability going forward. Also, if anyone is interested in any of the views expressed today by myself, Nalin or Ben, or would like to talk through opportunities in the sector, then our contact details are available below. And so I believe we just have a short amount of time to field some questions that have come through while we've been running the webinar. So if I pick up on the first one, sustainability is a key issue for occupiers, consumers and investors. And how do we see retail parks being able to address that issue of sustainability? Nalin, would you like to field this one?
Yeah, sure. I think the big thing that retail park owners are focusing on at the moment is electric vehicle charging. I know all the major landlords are focusing on that quite hard, and that seems to be the current route to achieving high levels of sustainability within the parks. From a personal perspective, I would love to see solar panels on the roofs, given that it's such a large, expansive space up there, but I think it might be a bit too idealistic to pursue that. Leases typically require the roofs to be the responsibility of tenants, and the physical structures of the buildings don't necessarily lend themselves to high loads on the roofs. But perhaps something to consider in the future of any new retail park developments that come forward.
Thanks, Nalin. We've also had a question about the dominance of click and collect as a format of product delivery, and how retail parks are placed to be able to respond to that. I think it offers a key opportunity, and again is a real potential strength of retail parks as a format going forward. I think click and collect is projected to account for about 13% of all online sales in the next couple of years, and that could potentially increase as occupiers are using it as a way of generating in-store visitation. And increasingly we are seeing occupiers charging for last mile delivery now, with a view of trying to reduce costs, improve sustainability and get footfall back into physical stores. So I think because of the elements that we touched on earlier around opening hours, the availability of parking, retail parks are really well set to respond to that increased interest in click and collect. And I think also something that's key is returns. And again, it's something that actually the consumer is shown to favour in terms of being able to return in store have that guarantee of returning an item, knowing it's got to where it's meant to be, and getting your refund processed much more quickly. So I think going forward, we will see click and collect and returns playing an increasingly prominent role in how we engage with physical retail. And that offers retail parks and their occupiers real strong opportunities to be able to leverage that footfall and almost provide a personalized offer in terms of knowing who their customer is, when they will be coming into store, and the types of products and options that they're interested in. So I appreciate most of our audience are pretty tight for time, so we will call a halt to proceedings there, but I'd just like to thank everyone for their attendance, particularly Nalin and Ben for providing that different insight to that provided by Pragma. As I say, this is part of a series of ongoing presentations from Pragma, and we look forward to hosting you for another session soon. Thank you very much, and have a good day to everyone.